Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, June 17th, 2024. Hope everyone had a wonderful Father's Day weekend out there. Just shout out to all my dads out there. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio, you need to be a client of 42 Macro. So, today's key macro events are European political turmoil, previewing the Bank of England, and deepening deflation in the Chinese property market. In terms of market implications, European political turmoil is facilitating a healthy debate between risk-on Goldilocks and risk-off deflation in asset markets. Our fundamental outlook suggests Goldilocks will win out from a medium-term perspective. Adverse positioning cycle dynamics makes deflation a higher probability outcome. Given this uncomfortable juxtaposition, this is no time for investors to get foolhardy about their predictions of where asset markets are headed. The growth, inflation, and policy cross-currents we have highlighted in recent reports continue to evolve in ways that suggest the easy money we have helped clients make during this bull run is increasingly in the rearview mirror. As such, investors must increasingly respect the evolution of our quantitative risk management signals, which have seen quite a few significant changes over the past few days. Refer to Dr. Mo on slide 6 for more details. Elsewhere, we believe the Bank of England is likely to implement deeper and faster than expected monetary easing, which should support the UK assets. Lastly, we believe deepening deflation in the Chinese property market is likely to keep Beijing actively supporting the Chinese economy and asset markets over the medium term. Transitioning to our 42 Macro community here, as always, we'll wrap up with a question from our community. Transitioning to our 42 Macro dashboard. As always, we're wrapping up with a question from our community. This one's regarding the petrodollar. So it reads, "Hi Darius, if you haven't already done so, would you mind opining on Saudi Arabia's decision to allow multi-currency sales of its oil? Main concerns on the U.S. are reducibility of U.S. to debt finance physical spending. This may be a good thing. Private sector, one, it's not a good thing, definitely not a good thing. We'll talk about each of these in succession. Number two, U.S. private sector interest rates on loans. Number three, reduced ability to export U.S. inflation. And number four, effects on the growth of the U.S. economy. Any insights would be greatly appreciated. So that's a great summary from the client here in terms of the implications of that over the long term. The first thing I'll say is that this is a long-term dynamic. The deep trading relationship between the U.S. and Saudi Arabia, more importantly, the U.S.'s negative net international investment position with respect to Saudi Arabia, neither of those is going to get resolved in a very short-term time horizon. This is something that could take years, if not decades, to truly unwind, if in fact that's what they wanted to do. We don't believe that that's what they want to do because, again, Saudi Arabia is tethered to the U.S. economy because we provide defense to them in an increasingly hostile Middle Eastern region with respect to where they sit politically in terms of that spectrum. So we don't think this relationship is going anywhere long term, but we've certainly probably well past the peak in terms of Saudi Arabia's support for the U.S. Treasury market. So going back to point number one, that does reduce the ability. It doesn't reduce our ability to spend. It reduces our ability to capitalize our spending at low interest rates. And so that obviously puts upward pressure on treasury yields from a supply-demand balance perspective. Number two, going back to U.S. private sector interest rates on loans. So obviously, if you're talking about treasuries that are rising in price in terms of term premium, the treasury market rising over the medium term, you could have treasury yields falling, but term premium widening because of these supply and demand dynamics. So term premium widening in the treasury market would obviously keep interest rates higher than they otherwise would be in the context of economic conditions, which would create an incremental drag on business activity. Number three, reduced ability for the U.S. to export inflation or deflation. This is less clear, in terms of the impact there. Typically what happens if the dollar's in free fall, you typically have commodity prices rising materially, particularly oil. That's why it's called the petrodollar. The relationship has changed quite a bit in the last kind of couple of decades, particularly with the advent of U.S. shale. U.S. has become the marginal producer of crude oil, so that inverse relationship between commodity prices and crude prices and the dollar and commodity prices, the dollar and crude prices, that inverse relationship has gotten less inverse over in recent years. It's still inverse, generally speaking, but it's not as a slam dunk, kind of a one-for-one inverse correlation as it had been. So to that point, there has been a reduced ability for the U.S. to export inflation or deflation, but it's not because of the lapse of this this pact, it's really because of the fact that the U.S. has become the swing producer of crude oil vis-a-vis shale. And then lastly, with respect to effects on the growth of the U.S. economy, we sort of talked about that with respect to the supply-demand dynamics in the treasury market, potentially inflating term premium, and how that would create more adverse outcomes on the perspective of capital market yields in the capital markets, equity risk premiums, credit spreads, et cetera. Not credit spreads, but credit yields, the yields on short-term and long-term debt obligations by the corporate sector and even consumer sector. Those could be, they could be asymmetrically higher or really uncomfortably higher relative to where they've been over the long term. And again, these are all long-term dynamics. If the U.S. and Saudi Arabia decide to do this, just completely divorce, it would take years, if not decades, to really fully unwind that. But obviously, markets are going to move well in advance of the ultimate termination, the ultimate destination. So we got to keep these types of risks glued to our screen. And the final thing I'll say on all this is exactly what you should be expecting. Breaking down of long-term institutions like the U.S. Saudi Arabia petrodollar pact. This is the kind of stuff you should expect to see in a fourth turning. I think we outside of Neil Howe and his late colleague Bill Strauss, I dare say we probably own the high ground in terms of what you should be expecting as an investor in this fourth turning regime from the perspective of the economy and asset markets. And so definitely refer to our Investing During a Fourth Turning Regime analysis for more details on that. That's always in the appendix of our monthly Macro Scouting report. So we'll wrap it up there. Darius Dale presenting our Macro Minute for Monday, June 17th, 2024. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.